Promising economic data locally from China and the USA. It's been another good news week, but what does it mean for interest rates and the Aussie dollar? We'll look into the crystal ball again as our financial year approaches its last quarter. The rebound in our growth rate was no great surprise, and we talked last year about the contraction in the third quarter being a pothole rather than a cliff. But the rebound was slightly stronger than expected, with GDP up 1.1% in the fourth quarter, so a healthy 2.4% annual growth rate, and avoiding the overstated implications of a technical recession. The recovery in resource exports was clearly a help, but it was good to also see a rebound in consumer activity and non-mining investment, adding to the renewed contribution from construction. The only disappointing aspect to the growth numbers was wages, which together with household disposable income fell once again. But the silver lining there is that this may encourage jobs growth as businesses can afford to build their workforce, consistent with recent business confidence gains. Hopefully, households can also enjoy the benefits of this growth via low interest rates and the low Aussie dollar. But one thing this data does suggest is the RBA won't be easing rates soon. And if commodity prices and the outlook in China keeps improving, the next move is more likely to be up. The Aussie dollar is still well supported, given the improved outlook in China, with Chinese manufacturing looking up, assisted by the latest pickup in global growth and offshore demand and higher commodity prices. For all the talk of Trump's protectionist policies and trade wars, China is yet to show any signs of this upsetting their soft landing scenario. And in the USA, the markets are still happy to focus on tax cuts and infrastructure investment, even though Donald Trump is long on exuberance but short on details when it comes to his phenomenal tax reform. The US Dow Jones only recently broke 20,000 for the first time on record. Now it's 21,000 and counting. And stock markets around the world are joining the party. So what will bring this unstuck? Perhaps the European Union will crash the party, with French far-right presidential-elect Marine Le Pen a 27% chance of beating the favourite Emmanuel Macron. And Le Pen is committed to removing France from the EU and returning to the French franc. How markets would react to that is very hard to gauge, given how surprising the reaction to Trump and Brexit has been. One thing this all has in common is a rise in inflationary risks around the globe, which is one reason the RBA appear to have changed their tune on cutting interest rates, especially with US rates likely to rise on March the 15th. Overall, this should keep our Aussie dollar in its well-established 72 to 78 cent range, but with the risk to the top side. Until next time, that's the market update from Bendigo Bank.